What I want to go on to now is what have you got today? So we talked about your £271 million, okay, project. So let's get into the asset itself, because where I want to get to, Brandon, is for you to tell me how this thing gets financed and the economics and so forth. But let's remind people what you've got first.
So Etango is an open pit uranium project. It's close to all of the infrastructure, including the mining town of Swakopmund. We're about 20 kilometres from China General Nuclear's Husab uranium mine, one of the largest in the world. And we're slightly further from the Rossing uranium mine that CNNC recently purchased from Rio Tinto. Close to all of the infrastructure that you would want. We're not relying on third parties to build roads, highways, railways, pipeline, ports, etc. And we're in Namibia, which has successfully exported uranium for 45 years and remains the fourth largest uranium producer in the world. It's a low-grade bulk tonnage project that not only is very, very large from a resource point of view, but exceptionally large from a production point of view. The average over the mine of life is 7.2 million pounds. And to give you some comparatives, that is enough uranium to service the requirements of 17 large-scale conventional nuclear reactors. So we are an asset that will assist the large-scale deployment of nuclear reactor fleets in a very significant way. Now that's very unusual, that scale. It's really only NextGen who can compete with that scale, and they're obviously in a different league and in terms of the scale that they are talking about delivering into at some point in the future. But what we do have that is very important for investors to understand, we have the potential for producible pounds into the next cycle. As this cycle heats up over the next 3 to 5 years, we have all of the long lead items in the bag already. We have environmental approval. We have the social impact assessment approved in Namibia. We have the infrastructure in place. Obviously, we've got the DFS and a 3-year pilot plant under our belt. All of those factors that traditionally in the uranium sector take an enormous amount of time and risk are already there for Etango and for Bannerman. And so for an ASX listed company, we think that puts us in a very unique and special place.
Okay, but I think the problem the market sees with your project, and if I'm looking at your share price, it's going to bounce along at 4 cents for a long time, since the last 3 years or so. People just don't get how you, as a $40 million market cap company, is going to get $800 million of funding, and where are you going to get it from?
And that's a fair criticism if you believe that our only option is to go down a conventional financing route. Conventional financing route from where we stand today would look ugly, and it would be very unlikely to deliver shareholder returns. And our board and myself, we're acutely aware of that. There are alternatives, particularly when you've got the scale and the strategic importance that we have. There's obviously the potential to do joint ventures at an asset level. There's a potential to obtain soft debt export financing type grants. To give you an idea of why we think those are realistic avenues to go down, that scale, as I mentioned, at full scale, 7.2 million pounds per annum, that services 17 nuclear power reactors of 1 gigawatt scale. The capex to build those reactors is about $80 billion US dollars, assuming that the Chinese are building them efficiently. So that 800 million is 1% of that. So the concept of getting soft debt from one or more utilities or sovereign debt to ensure that their investment of $80 billion is fueled over the long term with money that they would receive back once it's in production, I don't think that's unrealistic. And I think those numbers have a relativity that really makes that a coherent path forward. And of course, the vertical integration option is certainly a well-worn path in Africa for delivering exceptional shareholder returns, as we saw during the last boom, with Extract Resources being taken out for $2.4 billion, Mantra being taken out for over $1 billion, cash by sovereigns because they're in Africa.
Okay, so if I might just let me just say, sorry to interrupt, but Brandon. So, I mean, I kind of buy that vertical integration idea, but you've got to make it a reality, and you've got to do it. You talked about soft debt there, so I'd love to understand what that means. It's got to happen, and with a company at your scale, you're going to have to do it in a way that shareholders actually benefit from this thing, and it's not just a deal for whomever comes in. Presumably, I think you're indicating Chinese there. Have you got alternatives in case those numbers don't work your way? Are there smaller, earlier to start type models that you've been looking at?
Yes, we do. And we flagged in our quarterly report that we are looking at smaller scale operations where we can get into production at a smaller scale. Now, often what you see in bulk tonnage mines is they rely very heavily on economies of scale. And at 20 million tonnes per annum through the processing plant, Etango is a bulk tonnage operation. You won't get away from that. Where we're very blessed, though, is we've got an unusual ore body. Apart from being very homogeneous, very simple, very large, it outcrops. And about the first 50 million pounds have got a very, very low stripping ratio because of that. So that gives us quite a lot of flexibility to dial down our potential production. And what we hope is that by dialing it down to that level, the benefits that we get from reducing that stripping ratio not only counterweigh whatever economies of scale that we give up, but we're hoping that that might produce an economic benefit as well. And clearly that's going to go very heavily to that headline CapEx number. So what we would then have is two horses in this uranium race. We've got an enormous battle strider, which is capable of pulling even the heaviest carriages. And then we've got a more sprightly thoroughbred that can run the shorter races a lot faster. And we don't see one as being preferable to the other. They will just, each of those potential projects, if the smaller scale works for us from a numbers point of view, each of those potential projects will suit a different market and different end users with different levels of appetite. And once we've done that work and completed it, and on the assumption that the numbers come through in our favour, we expect that that will really position Bannerman in a very, very different way. And it certainly goes to the investor concerns that you've just highlighted.
Okay, so these are sort of questions which are coming in from subscribers and so forth. So you've got a DFS. You originally came out in 2012, you optimized it in 2015, and then again in 2017. Are you done with that? I mean, obviously you've got the smaller scale potential that you're looking at, but with regards to the large scale project, is the DFS complete now?
Well, with an enormous project like this, you never actually sit on a DFS. Well, assuming that you're still a believer in uranium and you've got a company that wants to produce, you don't sit on a DFS like this. When it's this big, even small wins, small reagent wins can add millions to your NPV. And that's what we've been doing. So you're right, the last optimization study that we did on the DFS was 2017. That coincided with the completion of our 3-year pilot plant program. We've just announced the membrane test work completed to a DFS level. That's a big win for us because we save an enormous amount on acid. As an example, so acid, it's our biggest reagent. Once we can put a number on that acid, and I'll come to the DFS update in a moment, once we can put a number on that acid saving, we think that for the large scale project, that'll be a tremendous boost to our NPV. And even the smaller reagent costs, like if we can recover 80% of the acid from the processing flow sheet, which those definitive level membrane test work has proven, that's a big saving on neutralization reagents. Neutralization reagents might only be several cents in the pound, but that adds a chunk to NPV when you're at this sort of scale. Now, what we need to do at the end of all of that is glue those pieces together via an updated DFS. And that's a DFS update process that we have been undergoing for a long period of time now. And I just want to explain that that's not a process that I'm in a hurry to draw to a conclusion.
Why not?
Well, first of all, once we draw that to a conclusion, we lose the opportunity to continue optimizing and working through the mid-priority level optimization targets. And we're getting a huge return on investment at the moment because we can do most of that work in-house using our existing resources with a little bit of help from consultants. But the bigger issue is this. If we were to say, right, the market wants us to update the DFS, or we need the news flow, or we think it'll make our share price go up or something like that, and we still see another 6 months or 12 months before the market turns significantly in our favour, we've now got a DFS update that's immediately starting to go stale. But what's even more relevant is when you're going to procurement on a DFS and you're asking suppliers of consumables or capital equipment to bid, if they don't see that this project is about to be built, they feel like they're negotiating against themselves. And the big engineering firms who are asking the questions, they're just filing away their numbers to be compared against competitors. You have to you've got to get them bidding with this procurement at the point where they think you're about to start financing and construction, and they've got a chance of being selected as the providers of that equipment, that reagent, et cetera, et cetera. So I'm not in a hurry to do those DFS update because I want the best numbers and numbers that are indicative of what we can build this project at. And if it means that I'm leaving quite a lot of value on the table at the moment, it hurts. It hurts to see the share price. It hurts to see some of the questions like you're posing at the moment about CapEx and so on. But that's still the best way of creating longer term shareholder value, in my opinion.